Right, good morning. Good morning, all. It's now the allotted time. I'm George Hallmey, very pleased to be with you this morning. And the topic that I'm going to be mainly spending quite a bit of time on is the dollar index. We really want to know which way the dollar is going. And it's been something which, of course, Forex traders are very, very focused on. And it exercises us pretty well constantly. And we've heard an awful lot about what is the main fundamental driver of the dollar. And that main fundamental driver, well, what is it? It's always historically been interest rates. And one wonders if that has really all changed or indeed not. Just looking through the list of those who are with us this morning. Yeah, nice to see quite a few of our regulars attending this morning. Let's just ponder for a moment on what has actually been happening with interest rates. Now, having said what I've just said, that interest rates are the big driver of the fundamentals of Forex moves, then we've clearly seen the Fed funds rate, for instance, the US Fed funds rate, at virtually a zero level, to all intents and purposes, since 2009. So 6 years. 6 years. Yeah, absolutely. Yeah. And since 2009, then we've had zero interest rates, and zero interest rates have really set the world alight in all sorts of different ways. Now, if we just consider the S&P 500, and we sort of think back a long period of time, and there we are. That's the chart going from 2009. Let's just put a little bit more on the screen there. And what we can see is that we had, really going back to after the tech crash, remember that? In the dim and distant past. Look at that, we've got a chart going right the way back to 93. We had this massive run up, and it's this big run up that is well worth just looking at, where it went from more or less there, and then we had the millennium, and what then happened, it crashed. And looking back on this, when we were in it, we were looking on this as being the biggest rally that we'd sort of ever known. And of course, prior to the rally, there were a good many sort of soothsayers who were saying that, oh, what, 400-500? No, it's unsustainable. We will find that the market's going to sell off. And of course, there were one or two notable commentators at the time who sort of more or less staked their reputations on it collapsing. And of course, the tech boom just took off. Now, that all came to an end with the millennium. And then, of course, we got the run down. We got this move down to around about 50%. Technically, quite an important level. Certainly, WD GAM would be to tell us all about the 50% level being really quite important. And then we had the rally on up, which surpassed the previous high. Only just. There we are. Look at that. We got a nice little false break higher, and then down it came with, of course, as we now know, we had then the major crash. But where did it crash to? Well, it did not crash much lower than the previous low. So if we look at this in overall terms, the crash down below this previous low was not that great. It was not that great. Now, technically, we often find that price will turn at about the level of a previous high or a previous low. It's one of those givens. It happens time and time again, and it's probably one of the most basic things that we as sort of technical traders if I can put us all into that camp, because I think probably the majority of us are predominantly technical traders, means that we need to be aware of that at all times. And those of us who've probably been around for a year or two in the markets, probably a decade or two for a good many of us, then we've got to be aware of that very, very, I wasn't going to use the word simple, it's one of those facts, and it stands the test of time. So we then got, following then the crash, we then drop into this zero interest rate situation. And of course, since then, as we know, that previous tech boom was just a little blip in comparison to the move that we subsequently had. I mean, percentage terms, if we were to look on a log scale chart, then it would be looking a little bit different. But if we just look in relative terms, from the low, we've had not quite a 3 times, increase, sort of running right the way then on up. So what about what is actually going on now? And if we look at the weekly chart, then what we can see is that throughout, well, certainly this year and most of last year, the market has been choppy. The market has been choppy. Chop, 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 chop. And then what do we get? We get something of a sell-off when it appeared that interest rates were actually going to rise. Now, we'd had subsequent Fed meetings throughout the latter half of, the latter half of 2014, throughout 2014, and particularly in the early parts of, certainly the first 2 quarters of 2015, telling us that there would be an interest rate rise, and consequently everyone was getting sort of very wound up about it, and the result of all of that is that the market started to get very jittery. On the one hand, they saw what was actually happening on the ground, which was zero interest rates, and the fact that we could borrow like crazy, and we could actually lock in some very, very good longer term sort of next to nothing interest rates. And of course that would fuel these rallies, and then out would come the Fed saying, oh no, we're going to be increasing interest rates. And of course that has had then the effect of this choppy behavior on the stock market, particularly as so many companies have been fueling their rises based on share buybacks. So when you look into the fundamentals of individual companies within the S&P, what we actually find is that there's an awful lot of sort of financial manipulation that's been going on. And that manipulation, amongst other things, of course, has been doing all of those things that... do you remember Enron? Do you remember Enron, who were sort of booking forward long-term contracts, 5-10 year contracts, and they were booking them forward. They were actually saying that, you've got this 10-year contract, rather than doing the sensible thing and booking those profits divided by 10 over the 10-year period. They're saying, oh, no, let's book all of those profits. We'd book them now. We'd book them this year. And of course, that was doing wonders for their individual executive share options, etc. And of course, that is the slippery slope that a lot of companies are still embarking on. They're doing it. They're doing it right now. And of course, tremendous number of share buybacks. And what do they use to buy those shares back? They use borrowed money. So if indeed there is genuinely going to be an increase in interest rates, those companies are going to be in big trouble. So we then got the sell-off, but we've then had a mother and a father of a rise coming right the way back up into the trend, because there is a belief, a rock-solid belief out there that the Fed will ease yet again. They will do whatever it takes to stop this stock market crashing, despite the fact that the true fundamental nature of what is actually going on out there is incredibly shaky. It is wafer thin. it is wafer thin. So that's the stock market for us. Now, why am I focusing on the stock market here and not looking at the dollar? Well, let's move over to the dollar in a second. All of these markets are absolutely, totally interlinked. And that's one of the real strong messages that we've just got to accept and take on board. What happens in one market ricochets down into another market. And, of course, it's interest rates which are driving all of this. We've had interest rates driving it up, and the prospect that interest rates just might really be going up are going to push it on back down. And when the reality hits, then we're going to be in uncharted territory. Why are we going to be in uncharted territory? Well, quite simply because if you consider the profile of those participants who are in trader positions in all sorts of hedge funds, in banks and so on, these guys and gals, they don't know anything else. They don't know anything else other than looking back to more or less zero interest rates. None of them have experienced, well, you know, there are still one or two grey-haired economists out there, but there aren't enough grey hairs because none of them have experienced what those who are around, certainly in the 80s, and very few of them experienced what actually happened in the 70s, when there was all sorts of monetary mayhem going on. So all they know is low interest rates and Fed bailouts. And eventually, then things will actually turn around and there will be an increase in interest rates. It is now starting to look as if the statements that have been made by Yellen, well, does anyone believe what she says? No, I don't think anyone really does. In general terms out there, it appears from what we hear that the Fed are in disarray. They are locked into. Yeah, we'll take a look at that in a minute. But what certainly appears to be happening out there is that the Western world is locked into this idea that in order to keep economies growing, we just loosen money. We just loosen money out there. And we effectively just push money into the economy. But the reality of it is that it is not working. It is not actually happening. And by loosening up the purse strings, all it's managing to do is to create what we've just looked at with the S&P, stock market bubbles, etc., and any sense and semblance of sound economics, allowing companies which are failing to go to the wall, and just a total non-acceptance of the fact that something other than just monetary loosening is what the economy actually needs. And there's a big lesson that needs to come from Iceland. And Iceland, what did it do? Tiny little country. And what happened with their banking crisis? Well, they have ended up putting bankers in prison. They defaulted where defaults, it can be argued, should have been carried out throughout the Western world. And their economy is doing incredibly well. So there we are. You know, Keynesians, monetarists, well, it's something that regrettably we're finding that the Fed is totally locked into. The Japanese are totally locked into. The Europeans, through Draghi, are now getting themselves, again, totally locked into the same idea. They are addicted to growth, and they will do whatever it takes And yeah, absolutely, absolutely. And what we're finding then is that because our various central bankers seem totally locked in to a particular policy mode, for them to actually turn around and say, oh, we better try something else, is incredibly difficult. And that try something else is to get ourselves back to some form of normality, which must mean a rise in interest rates, which will then rebalance the economy back to the normality that we desperately need. Anyway, there we are. That's just sort of setting the scene on all of this, that it's a political thing at the moment. And the dollar index, if we just look back on this dollar index, because that, after all, is what I should be looking at, we found that when the sort of first hints of interest rates rising sort of came up in mid 2014, last year, it kicked off this big rally. Now, since then, there has to be a degree of reality coming in, and we haven't seen it. We've got this sideways move. We've got this big sideways move. Is this going to break out on the upside or the downside? Well, I think as some commentators now are starting to come around to the idea that just if there is genuinely going to be an increase in December, then this market, has it got further to go? Well, one of the answers to that is just to look back historically, going right the way back to the start of that, not the start of, but the tech boom, where we had this big boom that ran on up, and that ran up more or less with the similar time frames that the stock market ran up with. And then, what do we find? That the dollar index just collapsed on down, and we know clearly sort of the reasons for all of that. And then eventually we drop into this period of time following the major crisis, following the subprime crisis. And we've now, with then this suggestion that we're going to get interest rates rising, moving on up again. So we've got this dollar index. And my question to you guys is, are we likely to see a higher dollar or a lower dollar? Now, just based on what we're looking at, well, it's entirely possible that the dollar has got the potential to go, considerably higher. Absolutely right, Pat. Short-term wise, considerably higher. I know that there are a lot of people who follow the likes of zerohedge.com, for instance, where that's the alternative view of the world, and it's probably quite a reasonable one to consider from time to time. And they're talking about the longer term position with the lack of interest, lack of the petrodollar effect. As time goes by, then the petrodollar is likely no longer to be the petrodollar. It's likely to be the ruble dollar. And we could find that influence, particularly political influence, over the longer term from the US is likely to wane quite considerably. But short term, quite what the short term is going to be, but it could still be counted in years, the dollar would still appear to be king dollar. And technically then, if we just look at this on the monthly chart, what can be seen then is that last month was an engulfing month. The tails of candles, the wicks, are all important. And the wicks of these candles, well, they're all suggesting that there's a support job going on, or at least there are those who are not wishing to sell their dollars. So there we are. Down below the 94 level, what we're finding then is that there is support. And if we just take last month as for instance, that support was sufficient October's move was sufficient then to leave September's traders just in the dust. And of course, the big thing on this longer-term chart is, are we going to see a decisive move up through 9,800? Well, it's starting to look reasonably likely that that will actually happen. Down to the weekly, and look at that. From the spring right the way through, we are stuck in and trapped into this, we're effectively locked into this trading range. Once we get out of this trading range, then I reckon that we are going to see something really quite dramatic. Excuse me. Now, I think we've got to mention just a little something about fibs. So if I just run back to where we were, and let's just pop a fib grid on, a very simple fib grid. I haven't got the automatic grid on here just at the moment, but this will serve our purpose. I mentioned a little earlier when we were looking at the S&P, the 50% level is all important, and the 50% level of retracements is something that W.D. Gann told us all about. It's not actually a Fibonacci level, but it's obviously built into Fibonacci grids that just show retracements. And 50%, according to Gann, was an all-important level, and price will gravitate back to, after a major move, to a 50% retracement. Now, we also know that there are other levels, and there are a good many of them, but 50% is a good rule of thumb. And if we look at where price is right now, it's not a million miles away from the 50% retracement. In fact, this consolidation is more or less, 50% is right bang in the middle of it, more or less. And if we look left, we can see that there was a previous peak right way back there in 93, and that's more or less where price went to. We've got a fair bit of price action here, more price action here, and that's exactly what we find, going back to the fact that we've got previous highs, previous lows. Where you've got previous levels of consolidation, that's where we are most likely to find current levels of consolidation, and that's exactly what we've got. Now, those followers of Fibonacci and harmonics will know that there are other really, really important levels, and those other really important levels tend to be the very deep retracements. And at the moment, we've got a relatively shallow retracement. Will it then run all the way up to maybe this Gartley level, or indeed the BAT level? And what I maintain is that, it's entirely possible that that will happen. And should we be looking for reversals at the 50% level? Well, this market is telling us that it's highly likely that we will see much, much higher levels in the US dollar. Once price gets up to around about a Gartley or BAT level, then the odds of a reversal of the trend actually changing and moving around, well, highly, highly likely indeed. Now let's just throw into the mix a little something extra. And this little something extra is a little bit of analysis using some Elliott wave moves. Now, I'm going to draw in a series of lines, and Elliott wave watchers will be able to tell me exactly what I'm putting in place here. I'm going to put in a little alternative. We've got a potential move up here, which this could be the wave 1, a wave 2. It's a higher low, so it qualifies as a wave 1, a wave 2. We then get this relatively major move running on up, and this would be a wave 3. What we've actually seen on this little correction, if you like, which has just run through end of 2014 into 15, we got a wave 4. Then what we could possibly get is a wave 5. Now, what we could do is to put that on. You can see what I've just done there. What I've managed to do, let's just bring that back out a fraction, is that I've taken wave 1 and I've then projected it forward as a wave 5. And what we so often find is that in Elliott terms, wave 5 is very often the same length as wave 1. Not always. Sometimes it's going to be a Fibonacci multiple, etc. But very often that's exactly what happens. And I've been looking at this now for a little while. I'm thinking, well, could there be something in this? Could we find that the dollar is going to work its way right up to the Gartley level before it decides to reverse? And so, excellent, Pan, excellent. You most certainly can. In reverse, of course, in reverse. So that's one possible scenario. Now, I'm actually just going to modify this a tad because, could be quite wrong. Just supposing that this was actually wave 1 and this was wave 2 and wave 3 went from here to here. What I'd then need to do is to move this up to there, and that little scenario would give us a wave 5, which, as we can see, is a little above, well, in hundreds of points terms, quite a few, hundreds of points above the 61.8 level, but in the region. So, just based on what we've been looking at right now, I'm looking at a region, a target region. There we are, a couple of blue lines, a target region, and it's clearly a very wide target region, but it's entirely possible we could well get the dollar index moving up through the big round number of 10,000, and we could well find that it's got 400 plus points above there. So there we are, folks. That's just my take on technically what the dollar index is doing. And if we boil that right the way back down to the fundamentals that might want to be driving it, well, that does rather tell us that if that's going to work out, what's going to be the driver of it? It's going to be a genuine interest rate increase. So there we are. Which one drives it? Does it need somebody to say fundamentally interest rates are actually going to go up? Janet Yellen is saying, right, we've pressed the button and interest rates are going to go up. Or is this all the real economy? Is what we're looking at reality? And it's not the political machinations of the Fed? Oh no, of course they're supposed to be independent, aren't they? Silly me. No, not those sort of machinations of what goes on in the Fed, but is this the real world? And is this going to be driving what actually goes on with interest rates? Well, there we are. That's a discussion for another day. But let's just look at that then, Pan. And it's probably well worth just taking a little glance then at the euro. Now, the euro, if we were to go to the monthly chart on this euro, then look at this. This is just the mirror image of what is going on. And if we, again, just look at what's going on with the candle action, then where are the tails? The tails are on the upside, and that's suggesting that there's a lot of encouragement to push this on down. If I use this little red line, we just pop it up a fraction, look at that, to the 2010 low, then this is an area where, there is resistance. And of course, there are a lot of commentators who are arguing this in both directions. They're saying that on the one hand, Mario Draghi is going to get his way. He's going to do whatever it takes. He's going to buy everything out there, and consequently, the euro is going to collapse. It's going to get down to that parity level that a year ago everyone was talking about. Everyone was talking about that parity level with the US dollar, the 1-to-1 level. But there are an increasing number of people who are saying exactly the opposite, that the Japan effect will take place, that despite buying up absolutely everything in sight, then they won't manage to actually weaken the currency. But of course the key is that US dollar. The key is the US dollar. And if the US dollar increases, there's only one way for this euro to go, and that is downward. Now, if we just take a little glance at this one, and there we are with a little bit more data on screen. Let's just put a grid on and see what that tells us. It's actually telling us that the decline in the euro has been somewhat greater than the increase that we've seen in the dollar index. So there we are. It's actually gone to and just popping through that 61.8 retracement area. And Pan, who do we believe? Well, all we can do is not believe any of them, and somehow or another mentally switch off from all of those comments. And we've just got to trade on what the markets are actually doing. At the moment, we've got an area of pretty strong support here for the euro. And if we look back, we can see that 2002, we got an area of support. And then going back to 98, 97, we've got areas there of support. And that's exactly where we found that the euro is just hovering. Now, there are one or two ways of actually looking at this then, and suggesting that, are we going to get a rise from here? Well, we could. We most certainly could get a rise. And in fact, what was that? Jim Mellon, the billionaire guy, he's totally convinced that the euro is going to be, it's going to be the bet of 2016. He may well be right. But for the moment, the charts are telling us that this area is vulnerable then to a further fall. Now, we could do what we've just done with looking at possible scenarios of Elliott waves. Yeah, well, we're traders. We're traders, Pan. That's what we've got to do. We've got to go with the moves. And, if the move is maybe doing the opposite of what commentators are telling us, well, so be it. So be it. If we were just to look at this area, and I'm going to take this little line, more or less picking out and suggesting that this could be a rather protracted head and shoulders pattern. We've got the head to approximately a neckline, we've got a left shoulder, and we've got a very, very difficult triple right shoulder over here. So if we now take this and project it on down, well, where does it go to? Well, where the euro was in 2000, in the year 2000. And that would be a complete and utter retracement. There's another little way that we could measure this. We could say that this move, the more recent move, down to this area, this is one of these flags or pennant. And again, technically, what we need to do is then, I don't want to play ball for the moment, there we are, grab it the right way. Then, if we were to look then at the distance of the first move down to the consolidation area and projected on down, that's suggesting the same. The target area for the euro is right down there on the floor. Now, believe it or not, and would you want to say, well, yeah, it's definitely going to happen? Well, now, of course, we couldn't possibly say that because we're just making wild suppositions as to what might actually work out. And our job as traders is not to get locked into any mode of thinking. So, we might listen to and read about Jim Mellon telling us that it's going to be, the euro. He's been saying it all year, that the euro is going to be one of the strongest currencies out there. And, we could say, oh, yeah, he's a nice guy, and, he speaks nicely, well, and I like the way he dresses, and so on. And I believe everything he says because of that. That is a slippery slope. That is a very, very slippery slope. We've got to be skeptical about absolutely everything that we hear. And that's exactly it, DV. Yeah, we just got to remain neutral, and we've got to be aware when we're actually trading of what could be colouring our judgment, because it gets coloured all the time by all sorts of things. We somehow have got to remain neutral and just not wed ourselves to an opinion. So there we are, back to the weekly chart. We can see that this market is stuck in something of a range. Let's come right the way back to the daily. Don't think we need that anymore. And what we can see then, we've got a red line down here, quite an important one. I'm going to pop another line just up here. Let's just use this line, and you can see what I've drawn in. We got a blue line, we got a red line, and there we are. There we are. We're in a trading range. We're in a trading range, folks. The dollar index, it's in a trading range. And yeah, within this trading range, we've got some tremendous opportunities. This one gave us a beautiful trigger up here. Okay? Yeah. Swing trend was pointing down. Activity index was pointing down. Price action was telling us that it was finding it difficult to get any higher above this blue line. And then we get a beautiful series of days just telling us that, this was not going up, it was going down. And there was only one thing that we could possibly do, and that is to sell. And that was to sell. Yeah, I mean, that's a good point there, DV Impact. So often we get ourselves emotionally wrapped up with what could have been, what should have been had we done it. And it's the trader's dilemma that we look at. What was that other guy commentator? Would have, could have, should have. I think he wrote a book about would have, could have, should have. And I think we could all do that. We could all look back on lost opportunities, and I guess that we could fill acres of print with would have, could have, should have. But all we can do is exactly that. Don't lament over history. What's history is history. It's not what we're doing today. And so all we can do is to look forward, and we can base our trading on what is actually going on in front of us right now, and consequently position ourselves accordingly. Now, a question might be that, let's assume that Trader Joe fortunately got himself short at about 113.50. Nice one, yeah. And I do like that play on NLP. Yeah. Yeah, well, we do these things to ourselves all the time. So the trader, having taken that short, and is now sitting on, a neat little sort of 300 pips of profit. What's that trader going to do? Is that trader going to say, Right, well, it's hit sort of roughly 3 times my risk, and so I read somewhere that I should close a trade at 3 to 1, and is at about 3 to 1. And then there'll be another trader who says, oh no, I looked at the longer term charts. This is going to go down to parity at the very least, and he's going to hold on, and it's going to stay with the position, and he's going to say, well, is that 3 to 1? No, it's going to be a 10 to 1 by the time I actually take the profits on it. You then get the other trader who's saying, oh, no, Jim Mullen's right. It's going to go up. It's going to go up. It's going to go up against me. What do I do? Well, my advice there is just to look at the charts. And if we look at the charts, let's look at where we are right now in the present moment. But let's look back to previous present moments. And if we look back, looking left on a chart is one of the best things we can ever do. We can actually see that price right now is in an area of what was uncertainty earlier this year, okay, well, earlier in the summer, I should say, and then there we are back in May, and if we go right back to, well, what's effectively the end of March, it again was in an area of uncertainty. Why do I call it an area of uncertainty? Well, because it's a consolidation area. We've got 1, 2, well, arguably 3, 4, sort of 5, 6. We are now in the 6th area of uncertainty, and what we do not know, for instance, for sure, we do not know for sure that the euro is definitely going to move on down. We do not know for sure that the euro is suddenly going to rally on up. We just do not know that. None of us do. We can formulate some sort of a plan based on it, and the thing to do is to formulate a plan which means that our 300 pips of profit, would we want to give all of that back? You know, Jim Mullen might be right, and it could come back, and all of a sudden we lose 300 pips because of that. If we were to take all of our profits right now, and then it collapses on down another 400, 500, 600 pips, then we're going to be saying, oh no, I closed it at 300. I could have made 1,000 pips. Well, the thing to do is to use the split trade idea, or the multiple position approach that I've always adopted. And that is, I've had a good run. I do not want to give money back. My purpose in these markets is to, let's have the challenge, but let's also make some money. We've got to make money. And if I'm sitting on 300 pips worth of profit, I am going to be taking a good lump of that profit. And then that trade, which has served me really, really well, I'm going to take a big lump of the profits. I'm going to leave a little piece of the action on, because it just might go down to parity. It might. And I'll also put a stop on it, which means that of my 300 pips, I'm not going to give back more than 100 pips. So, if I've sold 3 lots, I'm going to be closing 2 lots here. On the 3rd lot, I'm not going to give back more than 100 pips of profit. And that final lot, I don't mind what it does. I can just completely and utterly forget it. And then move on to a different market and see where we are. Right, well, where you get this level, Mr. C, is that you've got to have some form of a plan, and that's my sort of plan, and that's how I sort of play it out day after day or week after week. And when I look at a market and I think, well, look, I'm not absolutely clear on this at the moment. Back there I was absolutely clear what had to be done, and that was it. There was only one thing to do. The other thing I'm clear about is that I'm unclear. here. Because what I so often find is that a market will actually reverse in the region of a previous reversal. It will very often reverse once we start to look at retracements that are very deep retracements. And there we are, we're between the Gartley and the BAT level. And that's exactly the area that we are likely to get a reversal. So I want to get positioned for uncertainty. And I see uncertainty here. Now, in answer to your question, where would I want to go short? Well, I wouldn't at the moment. I wouldn't want to take a short here at all. What might tempt me is that, let's just suppose that this trading range did actually break and we get price actually dropping out of the sky down here. Well, I'm probably going to be very pleased about that, and it will mean that my final lot is going to be, making a fair bit more money, and I can start to bring the stop profit level on that down and increase the ultimate profit that I take out of it. But what I would be looking for is some form of a snapback back up to a level of resistance. So my answer to that is that I wouldn't want to do that right now. But just supposing from this level, Jim Mellon was partly right, and it did a bounce up. I would then be looking at my Fibonacci levels. I would be looking for price to come back on a deep retracement. And if it came back up to more or less the area where I shorted it previously, obviously my final lot would have been taken out by then, and it started to move on back down again, and it gave me another little setup, I'll do it. I'll take it. But at the moment, my plan is to let this market just get on with it and tell me where it's going to go next. I don't know. And I don't know is something that, a lot of traders have a bit of a problem with. They really do have a bit of a problem with it. Right, okay, folks. Well, that's taken a little glance at some of those bits and pieces, and I'm just going to squeeze a little bit more time. All of these charts, by the way, as you can see, they haven't got millions of indicators on them, and this comes from the 20-minute swing trader program. You can just look at this, and you can get heads up on what's going on in an instant. Well, I reckon about 20 minutes to go and look through. I generally look at about, between 25 and 30 charts every day, and it takes no time at all to do it. You can see at a glance what is actually going on. Combination of price action, where we are in relation to previous highs, previous lows, where we are in relation to trading ranges, and what is going on with the activity index, and what is going on with the swing trend. So that little combination can serve you exceedingly well. Now, what about this one? Where's this thing going? There were those, and at one time I was amongst them. I was saying that, there were times when we were trading this at 130, 133. Going way back now, going way back. No, I haven't got enough data on here, but there was a time when we were trading the US dollar against Japanese yen at around about that 133 level, and we had some tremendous moves when sort of various bits of intervention were coming in, when Japanese exporters were saying, we can't cope with this strong, we just cannot cope with a strong Japanese yen. And the Japanese finance ministry was effectively telling us what to do, and we just did it, and we made money. Things are possibly a tad different now. We've had this latest round of easing. Things have moved on up. Notice this. We've got a move up, a correction, and then a move on. It's an A, B, C move, one of the best moves in the market. And that ABC move, where has it gone to? It's gone to this area of prior price action back in 2006. This market cannot make its mind up what it's going to do. Looking at this on the monthly, November, October, September, what happened in August? It went higher, it went lower. It completely engulfed July. Not quite sure what it's going to do. Are we in a trading range? Well, look at this. We are in a trading range, without a doubt. And, is this a head and shoulders? Is it going to push the US dollar lower against a stronger Japanese yen? Or indeed, are we going to get another leg on the upside? Well, either could happen. But this market is telling us that, for whatever reason, it is not ready to weaken this Japanese yen substantially yet. Now, we're getting one or two little signs on the daily that just maybe it wants to, but until either of these blue lines get broken, I'm not going to take any longer term position on this at all. But we did get a nice little single day of hammer candle back here when it said buy it. We then move up to this beautiful little Hallmey break. It's saying buy some more. So we got a nice little run on the upside. And those moves that in this market, this current market, are running for 3 to 7 day moves. They're the ones that this current market in Forex, in the likes of gold, we're finding that is where the money is made. Just look at some of these rallies. We got this sort of wonderful move on up, and we then get 1, 2, 3, 4, a fifth up day running. We've now had on this move that went higher, it went lower. Look at how many days that is engulfed, bearish engulfing. What do we as traders have to do? Just take the signal. Just take the break point. That's it. How long has this run? 1, 2, 3, 4, 5 days. Is it going to move much more than that? Well, possibly, but possibly not. It now might want to consolidate because it's come back to an area of where there was uncertainty before and where there was a fair bit of consolidation there. So that's exactly what we've got to be very, very careful of. We don't want to just hold on too long that we end up giving back umpteen profits. What we need to do is to be prepared to take our profits on these moves, or at least a large share of those profits, and then say, I'm going to look at another market. Fine. Adinda, I'm actually getting the eye at the moment saying that it's time to maybe just allow somebody else to take over. So thank you very much indeed for being with me, and great questions this morning, great questions. And don't hesitate to get in touch with me, and I believe you certainly know how to do that. I will just put my email address in, support@clickevents.co.uk. Will find me. All the best for now, folks. Be with you again next month.